Your mortgage payment is the biggest bill you pay every month. $1,500, $2,000, $2,500, maybe more. That money leaves your account every single month and goes straight to the bank. But what if I told you there is a completely legal way to pause that payment for 3, 6, even 12 months? Keep the money and invest it in something that grows while you are not paying the mortgage? No late fees, no credit damage, no foreclosure risk. It is called forbearance, and the banks are required by law to offer it under specific circumstances. Most homeowners have no idea this option exists. The ones who do are using it to build wealth, while everyone else sends their check to the bank on the first of every month. Here is exactly how it works: who qualifies, how to apply, and the investment strategy that turns paused mortgage payments into real money. This is not financial advice. This is financial education. Talk to your own advisors before making any moves. But the information itself, the banks definitely do not want you to have it. First, let me explain what forbearance actually is, because most people confuse it with forgiveness. Forbearance is not the bank forgiving your mortgage. They are not wiping away what you owe. Forbearance is a temporary pause or reduction in your monthly mortgage payments. The bank agrees to let you stop paying for a set period, usually 3 to 6 months, sometimes up to 12, without reporting you as delinquent to the credit bureaus. Your credit score stays intact. No late fees, no foreclosure proceedings. The missed payments get added to the end of your loan, or you work out a repayment plan after the forbearance period ends. The key word is temporary. You still owe the money, but you do not have to pay it right now. And that timing difference is where the strategy lives. Now, who qualifies for forbearance? This is where most people give up because they assume it is only for people who are about to lose their home. That is wrong. Here are the legitimate reasons you can request forbearance right now in 2026. Reason 1. A natural disaster or property damage. If your home has been damaged by a hurricane, flood, fire, tornado, or any covered insurance event, you have a right to request forbearance while repairs are being made. FEMA-declared disaster areas automatically qualify, but even without a FEMA declaration, if you have an active insurance claim for property damage, most servicers will grant forbearance because the property, which is their collateral, is damaged. You are dealing with displacement, temporary housing, contractor costs, and the stress of rebuilding. The bank knows this. They would rather pause your payments than have you default. Reason 2. Job loss or income reduction. If you lost your job, had your hours cut, or experienced a significant drop in income, you qualify for forbearance. You do not need to be completely unemployed. A reduction in income that makes your mortgage payment a hardship is sufficient. The bank's servicing guidelines require them to evaluate your request based on your current financial situation, not your past income. Reason 3. Medical hardship. A serious illness, injury, or medical event that impacts your ability to work or generates significant medical bills is a qualifying hardship. This includes both physical and mental health conditions. If medical expenses are consuming income that would otherwise go to your mortgage, that is a legitimate forbearance reason. Reason 4. Divorce or separation. The financial disruption of a divorce, splitting households, legal fees, transitioning from 2 incomes to 1, is a recognized hardship. Many servicers will grant forbearance during an active divorce proceeding. Reason 5. Military service. The Service Members Civil Relief Act gives active duty military members the right to request forbearance. If you are deployed or reassigned, your mortgage servicer must accommodate you. Reason 6. Death of a co-borrower or spouse. If your spouse or co-borrower passes away and you are now solely responsible for a payment that was sized for 2 incomes, that is a qualifying hardship. Reason 7. And this is the one almost nobody knows about. You can request forbearance simply because you are experiencing a financial hardship. The federal guidelines that came out of the pandemic era expanded the definition of hardship significantly. Many servicers will grant forbearance for any documented financial difficulty. You do not need a catastrophic event. You need a legitimate hardship and a phone call. Here is exactly how to apply. Step 1. Call your mortgage servicer. Not the bank that originated your loan, the company that sends you your monthly statement. That is your servicer. The number is on your mortgage statement. Step 2. Ask to speak with the loss mitigation department. Say these exact words. I am experiencing a financial hardship and I would like to request forbearance on my mortgage. Step 3. They will ask you to describe your hardship. Be specific. If it is property damage, reference your insurance claim number. If it is income loss, state the amount of reduction. If it is medical, reference the condition and its impact on your finances. Step 4. They will either approve you on the phone or send you a short application. Most servicers can approve forbearance verbally within one phone call. Step 5. Get the approval in writing. Ask them to send you written confirmation of the forbearance terms, the start date, the end date, and confirmation that no late fees will accrue and no negative credit reporting will occur during the forbearance period. This written confirmation is your protection. Do not skip this step. Now here is where the strategy gets interesting. Your mortgage payment just stopped. Let us say your payment is $2,000 per month and you received a 6-month forbearance. That is $12,000 that is not leaving your account over the next 6 months. That money is sitting in your checking account. Most people would just spend it. They would let it absorb into their daily expenses without even noticing. That is the wrong move. Here is the right move. Take that $2,000 every single month and invest it. Not in crypto, not in meme stocks, not in your cousin's business idea. Put it into proven income-generating assets that are working for you while the bank waits. Investment option 1, a high-yield savings account paying 4 to 5% right now. $12,000 in a high-yield account for 6 months at 4.5% earns you roughly $270 in risk-free interest. Your money grew while your mortgage was paused. That is free money that would not exist if you had been sending $2,000 to the bank every month. Investment option 2, put it into dividend ETFs. Funds like JEPI, SCHD, or SPYI pay monthly or quarterly dividends. JEPI currently yields around 7%. $12,000 in JEPI for 6 months generates roughly $420 in dividend income. And if the share price goes up during that period, you also have capital appreciation on top of the dividends. Investment option 3. Use the accumulated cash as a down payment on an investment property. 6 months of saved mortgage payments at $2,000 gives you $12,000. That is enough for a 3.5% FHA down payment on a property up to $340,000. You buy a rental property. A tenant pays the mortgage on that property. You now have 2 properties: your primary home where the mortgage is in forbearance, and a rental that is generating income. When the forbearance ends and you resume your original mortgage payments, the rental income from the second property helps cover it. Investment option 4. Pay off high-interest debt. If you have credit card debt at 22 to 28% interest, using your paused mortgage payment to eliminate that debt generates a guaranteed return equal to whatever interest rate you were paying. Paying off $5,000 in credit card debt at 25% interest is the equivalent of earning 25% on a $5,000 investment. There is no stock, no fund, no asset class that guarantees 25% returns. Debt elimination does. Now, let me address what happens when the forbearance ends, because this is where people get scared. You have 3 options. Option 1, lump sum repayment. You pay back all the missed payments at once. This only makes sense if your investment returns gave you enough to cover it. Option 2, repayment plan. The servicer spreads the missed payments across your remaining loan term, slightly increasing your monthly payment. On a 30-year mortgage, spreading $12,000 across the remaining payments might add $50 to $100 per month. That is manageable. Option 3, loan modification. The servicer adds the missed payments to the end of your loan, extending it by 6 months. Your monthly payment stays exactly the same. You just pay for 6 months longer at the end. Most people choose option 3 because it has 0 impact on their monthly budget. Here is the math on why this strategy works. Let us say you have a $2,000 mortgage payment and you get 6 months of forbearance. You invest the $12,000 in a mix of high-yield savings and dividend ETFs. Over 6 months, you earn roughly $350 to $500 in interest and dividends. When forbearance ends, you choose the loan modification option. The missed payments get added to the end of your loan. Your monthly payment does not change. You resume paying $2,000 per month just like before, but you now have $12,000 in investments that are still growing and paying you dividends, plus the $350 to $500 you already earned. You use the bank's money that was technically owed to them, as capital to build your investment portfolio. And the cost to you was zero because the loan modification just adds 6 months to a 30-year mortgage. 6 months on a 30-year timeline is negligible. Now I have to give you the risks because this is not a risk-free strategy, and anyone who tells you it is would be lying. Risk 1. If you invest in the stock market and it drops during your forbearance period, you could lose money. That is why the high-yield savings option exists as the safest play. Risk 2. Some servicers may not offer the loan modification option. They might require lump sum or repayment plan. Ask about end of forbearance options before you apply so you know exactly what you are agreeing to. Risk 3. Forbearance does not mean forgiveness. You still owe every dollar. If you spend the money instead of investing it, you are in a worse position when forbearance ends because now you owe back payments with no plan to cover them. Risk 4. While federal guidelines protect your credit during forbearance, some mortgage lenders for future loans may ask if you have ever been in forbearance. This could theoretically affect your ability to get a second mortgage, though in practice this is rare and the impact is minimal. Here is who this strategy is actually for. It is for homeowners who have a legitimate qualifying hardship and who have the discipline to invest the money instead of spending it. If you are going to take the $2,000 per month and blow it on vacations and shopping, do not do this. Pay your mortgage. But if you are strategic, if you are the kind of person who sees an opportunity in a system that most people do not even know exists, this is one of the most powerful wealth-building moves available to middle-class homeowners. The banking system is designed so that money flows in one direction, from you to them. Forbearance is one of the rare moments where the flow pauses and you get to redirect that money somewhere that benefits you. The banks will never suggest this strategy. They will never call you and say, hey, you qualify for forbearance, you should invest your payments. They want the money. Every month. On time. Without question. Now you know you have a choice. This is not financial advice. Talk to your mortgage servicer, your financial advisor, and your tax professional before making any decisions. But the strategy is real. The math is real. And the opportunity is available to millions of homeowners who have no idea it exists. Now you know it exists. If this just opened your eyes to a strategy you have never heard before, subscribe. New videos every single day breaking down the systems that control your money. The stuff nobody teaches you. Hit subscribe, and I will see you tomorrow.